Hi everyone, today I wanted to talk about cash flow versus capital appreciation when it comes to property. So these are two different factors. Cash flow pertains more to the monthly income that you receive from a property investment, whereas capital appreciation refers to the increase in value of the property, which can be utilised when remortgaging. With regards to cash flow, when you buy a BTL property, the mortgage, for example, is £500 a month, but you may receive £1,000 a month in rental income. This means your profit is £500 a month. This is monthly reoccurring, and this starts working as soon as you tenant your properties. So this is cash flow. Whereas if you buy a property for £100,000, in 5 years it might be worth £150,000. So then you can remortgage the property in order to pull out this increase in value. So you'll be able to pull out maybe not all, but a significant part of this appreciation. So you get a lump sum in your account which you can use for whatever you want, whether you want to spend it or reinvest. I would advise reinvesting this and just using portions of the money on things that you enjoy. This debate matters to landlords and property investors because it depends on your personality type, really. There's no wrong or right. Some people want the security of capital appreciation, whereas other people want to utilise the cash flow. It's often best to have a mix between the two, so this is why it's good to invest in properties that appreciate quite a lot and have decent cash flow. Luckily in Coventry, for the last number of years, Warwick Uni has been doing very well, but also Jaguar Land Rover has boomed, and also Coventry University boomed significantly. This brought a lot of economy to the city. This means there was a lot of demand for student tenant properties, and also the properties in the country invested. London has become too expensive for quite some time, which means a lot of the landlords from London moved further north, and Coventry was a hotspot. For quite some time, I believe it has been in the top 10 for property investment cities in the country. This means it is great for both cash flow and capital appreciation. The more people that buy properties here, the higher the property prices will become. The more students that come here, the more the rental demand will become. But this is a slightly different story, as this was not always the case, because as soon as Coventry University worked this out, they built their own student accommodations to take the market away from their landlords. Article 4 was introduced here as well, so this significantly limits the number of HMO properties that can be used to house students. Cash flow provides steady, predictable income and helps cover expenses immediately. Capital appreciation is something that's trapped and whose value can be realised at a later date. So if you're more of a patient investor, you can sit and wait until you refinance your property and utilise the capital appreciation that's been realised. Or many people can invest in one or two properties and just leave them there for years and then use the capital appreciation and rental income from this in their retirement. I do know of someone who lives in Putney. He bought his house there in 1985 for £29,000. About 10 years ago, this property was valued at £980,000. So this is an example of an extremely good capital appreciation. However, he has no interest or understanding of the property market, so will never utilise this increase in value. But it just goes to show what's possible. If this property were utilised for property investment, an idea would be to refinance it. So pull out 75% of the value and use this to build a portfolio perhaps inside or even better outside London, which the owner of the property could then benefit for. This is a great example of how capital appreciation could be used to pull out the equity from a property and then invest in another portfolio that gives cash flow and potentially capital appreciation as well. The northeast of England is perhaps on the other end of the scale, wherein properties are very cheap. They can be between £5,000 and £25,000. Some of them, according to some YouTube videos, can yield about £400 to £600 a month. So for a £5,000 to £20,000 investment, you can make about £6,000 a year, which is extremely good return on investment. The issue with these properties is that there is not much capital appreciation in that area, so it depends what you want. To instantly lock down a property without a mortgage, you can purchase one of these and just leave it to cash flow, and the cash flow should kick in quite quickly. I have heard that in certain areas these properties do have high risk tenants, and if left empty for even a short amount of time it can be quite risky, because apparently people even go in and steal boilers. But then again, it depends on the city and who's managing the property and other socio-economic factors. An example of very high cash flow strategy when it comes to properties is serviced accommodation. Rent-to-rent properties, when utilised in this way, can yield great cash flow opportunities. For example, I know of someone nearby. He manages a large number of serviced accommodation units, and he does this by not buying but by renting a number of flats off a landlord. The landlord is quite old and doesn't want to deal with renting out the properties anymore, so the serviced accommodation person rents them off him and then converts them to a serviced accommodation and then rents them out again at a significant